We'll do it live.
Okay.
We'll do it live. F it. Do it live. I'll write it and we'll do it live. F***ing thing sucks.
Yeah.
All right, welcome back to the Capital Mindset Show. It's been a really long time that we've done one of these. Yeah, it has been a while. This has been pretty much taking up the entirety of my time right now. This is much easier than the other one, I'll tell you that. Even though some people say that it's between this one and the other one that's harder. I think it's not bad. I think it's just the time crunch that I'm having to do this in. But yeah, so that's been pretty much taking up my time. And so here we are on that. And if you guys want to know what I'm drinking here, this is Guaraná. Okay, so it's actually a Brazilian soda. It's pretty good. But if you guys are familiar with that, if you guys were wondering, I know some of you are actually Brazilian or, are familiar with Guaraná. All right, so with that being said, I have some topics here. I'm going to kind of kill two birds with one stone. One of the things I wanted to do here is I do a call every Sunday, and something happened with the audio on the call. So basically, anyone who watched that call or didn't get to watch the call, sorry, I usually leave a recording for them. But I also haven't done a live stream in a long time. So I thought I'd kind of go over a lot of the topics. It won't be the same length because that call I think was like 5 hours. But I can kind of break down each of those topics. And this is one of the only times I'm going to do that, by the way, because it was an accident that the audio didn't record. And I can kind of kill, again, two birds with one stone, do a live stream, also have something for them to kind of look back on and summarize that call. But anyways, so I guess we started off by talking about some REITs, okay? And regardless, again, if this gets views or not, I don't really care, but just to fulfill that promise to those people so that they have this. And also kind of do a live stream, answer some questions you guys have any. But yeah, hello. I'm looking at some of the comments coming in. Hello, Mr. Also Janitor. I'll promote you to head janitor, Matthew Matlock. Okay, so let's see here. Very sad. Yeah, it did record. No, it's just you can hear actually only the other speakers. You can't hear me. So it's like it's most of it's just you can't hear anything. So it's I think it was an error, something when I changed some of the settings in the recording software. I forgot to revert the settings and a little goofball. I need to check those things, but I'm getting better at it. This is not my primary, you could say, form of work, and that kind of shows sometimes. All right, so the first thing I guess I'll talk about is some of the REITs that I started off with, which was, and I have them here, data center. So I started talking about data center REITs, and some of the things that people don't know about data center REITs is if you're ever involved with the actual rental agreements, you'll know that they're not as simple as a lot of retail investors think they are. So with a data center, you don't just rent out the server space. Okay, there's actual agreements that are, well, it depends on how much usage you have. Okay, similar to how cloud is charged to a client. So if you actually have ever been involved in some agreement with a cloud service provider, you're familiar with that. It's basically pay as you use. So the more you use, the more you'll actually get charged for. So these data center REITs operate on a similar basis. And if you go to any of their financials, they'll actually tell you that as part of their business in either their 10K, 10Q, and they'll tell you, okay, well, one of the risks associated with this business is, of course, energy. And we're discussing some of them regarding how much energy are they using, how much of their energy costs really affecting them. Let me see if I have it still pulled up because I didn't close any of the links, thank goodness. So don't really have to look too far as pulling these up. But I'm trying to just basically follow my path from that day. Let's see how good I do with it, but hopefully it's not too bad. So we also looked at some like Iron Mountain, Equinix, so EQIX. So I'll go ahead and start showing that one. We'll get to this REIT in a second, but because we're going to try to follow my path. All right, I guess Google's not this search bar for some reason, don't know why it's actually not populating. So I guess we'll ignore it. We'll go to the other search bar. Okay, there we go. Now I was like, Google, you can't do this to me. So the biggest one, or the largest one, is EQIX, or I don't know where the U came from. So EQIX, Equinix. So this one trades for about 57 billion US dollars, and it has locations all over the world. So for those of you who've been questioning or maybe think about, well, is it very important to be all over the world? Well, yes, because data centers, the closer you are to where the data is being called from, it increases the speed. It depends on really the use case, whether that it's very important or not that important. But for the most part, it's just better to have this wide network around the world. EQIX has the best infrastructure in this case. So they're considered to be, the best. So if we're going over the top, this is the best one right now. They are, well, if you look at actually their share in terms of business, let me see if I still have that pulled up, that slide deck, because I should have mostly everything pulled up. All right, yes, I do. All right, so we'll go ahead and go over this. So this is the network, and I'll show you guys in a second the right here. So you guys should be able to see this. All right, so let me actually center you guys right there. All right, so you guys should be able to see that. And I don't know where I'm going to move myself. I'll put myself up here. I'll make myself tiny. Let's make myself really tiny. You don't need to see me. I don't really matter. Okay, so we have a market cap of 57.48 billion, and the presentation, as we'll start right here in the country, so you can kind of see, and I'll move out the comment. All right, so if you see here, you can see the presence in the different regions. And of course, again, as I said, it is pretty important to the location of where it is for the quality of when you call the data, that speed, the latency. So if you notice, for example, when we do live streams that Investing with Cole is on, and he sometimes sees the comments faster than Chris or I, it's because of his location relative to where the data is being pulled from. So wherever the servers is hosting the live stream, right, or whatever YouTube's using, or in this case, Google. And then they have a slide deck in here, I think it is. No, it's not this one. Where's the slide? There's a slide that actually shows us the amount that they basically control. I don't know if it's pulled up in this one or I have it pulled up somewhere else. I might have to go search for this one. But basically, if you just take my word for it, that EQIX is the largest in their space, and they have the most market share. I think I have it pulled up here. Let me check. It's strange. I thought I had it pulled up somewhere. I might have closed it. That's one I might have closed. Is this it? No, this is definitely not it. It was also a bunch of circle graphs. But anyways, yeah, just take my word for it that this is the largest one, and they have the most market share for, I think, AWS, Azure, Google Cloud, and Oracle. And then the second one that comes afterwards, after them, is DLR. So DLR is Digital Realty Trust. Pull them up here for you as well. So their market cap is at $33.99 billion. Don't worry about the P ratio, again, with REITs, because REITs are a little bit different. They follow a set of rules. So, for example, one of the things, they have to pay out 90% of their taxable income in the form of dividends to shareholders, and they are a pass-through entity, meaning they don't really pay, they don't pay taxes on the corporate level. So a pass-through entity passes all the tax liability onto you, and if you actually go on the internet for looking this up, you might find that a lot of sources tell you that it's best to hold a REIT in a tax advantage account, which I would tend to agree. If I invest in REITs, I typically like to put them in my tax advantage accounts, Roth IRA, if depending on your employer, if they're very flexible with their 401k. But yeah, for the most part, like to put them in tax advantage accounts, and you can reinvest those dividends back into the business, or do whatever you want with them, reinvest into another business, but you won't get taxed whatsoever on any level, the corporate level or even the individual level. So that's good. But another thing about REITs is that you'll see a lot of dilution. I'm just mentioning that because I've had that question come about here and there. For someone just getting into the markets and saying, what are these REITs? And they hear dilution is bad, and then they look at a REIT and they say, oh, look at all that dilution, that's bad. Well, REITs, it's pretty normal because, again, if they're paying out most of their taxable income to shareholders, taxable income, because technically if you look at it on a cash flow basis, it actually could be less because of something called depreciation. We won't get into that. I guess most of you already know that. People who watch my channel typically already know that stuff. But if you don't know, you can ask. We'll get into that. So yeah, basically we went over data center REITs as kind of the beginning point. And one thing, again, that is a risk is all this energy fiasco that's going on right now. And of course, we looked at EQIX in terms of their management with regards to energy usage. And it seemed like their gross margins over the 6 months period has actually declined. But over the quarter over quarter, so this quarter from compared to quarter last year, we saw an actual increase because energy's kind of tapered off and actually come down a little bit. You might have noticed it at the pump. I've noticed it at the pump when my wife and I went to Miami recently, and we actually noticed that, okay, when we filled up the car, the gas prices have come down. All right, so I don't really get to see it unless I'm using my wife's car or helping her fill up the gas or the gas in the car because I don't use gas anymore. But yeah, regardless, that's basically something that you want to pay attention to because energy costs are variable. Digital Realty Trust and EQIX will both tell you that that's a risk for them. It's that variable usage of energy, that cost of energy, that's a bit of a risk for them. They have, depending on the agreements that they'll do with their tenants, let's call them tenants, they'll pass on the cost to a point. It depends because sometimes maybe it's uncapped, but other times it can be capped. So then there's another one that is kind of like the ugliest one, but, well, I'd say ugliest one. They recently been going through a bit of a turnaround, and that is IRM. So Iron Mountain. All right, so this is the last REIT that we talked about in this space. So IRM is, they also do services. So if you actually go into their financial statements, you'll notice a service-based revenue as well as rental revenue from their different properties. So some of the services that you may not know that they provide is shredding. So they do secured shredding services. When you go to a bank and they have your information and you wonder what they do with that paperwork, they shred it. You were right if you thought that, but they don't really shred it. They put it in a bin in the back and it goes to this Iron Mountain facility where they do a secure shred on those documents. And so that's one of the services they do provide. They also have storage for different artifacts. You can call them well, let's call them artifacts at this point, but you go here, you can see their solutions, and you can go to, well, there's data centers, by the way. This is fairly new for Iron Mountain. They've been getting into this pretty heavy recently. Again, they'll show you the locations to stress again why that's important. When they go to their clients, they say, look at all of our locations. So if you go to, again, going back to solutions, you will see the different things that they do offer, the industries that they serve, and then the services, the different services you can see, offsite record storage. So depending on the business that you're in, you might be required to hold documents for a certain period of time, and you don't want to hold them, and governments might actually require it to be in a physical copy. So not just a digital copy, a physical copy, because you might be wondering, well, what's stopping me from doing just a digital copy? Well, some, depending on what the document is, you need a digital and a physical, maybe just a physical is required, and then you use a digital for convenience, etc. So Iron Mountain's there to be there to store the physical copy if you need so as well. And also, you know, like the original record, for example, I call those, let's call those artifacts. An original movie, the first original tape of a movie, a company will probably have that and they'll store it at maybe an Iron Mountain facility. Like I was saying, bulk paper shredding, residential shredding, and then secure shredding, like I was saying in the secured shredding services there. So you'll see that, and then IT asset disposition, yeah, they'll do that as well. So you can break down their services, but they're considered the ugly duckling of the data center REITs right now, and they've gone through a change. So let's see here. So I also talked about some other REITs, and some of the other REITs that I'll kind of forego like the personal stories and stuff like that. I'll just stick to like the TLDR basically on some of these. So another REIT that we did discuss is these ugly REITs that are no longer ugly. They're very desirable. So if you ever have an opportunity in your lifetime to do kind of a deal regarding trailer parks or something like that, one of those properties, they're actually one of the most desirable properties to own, and that's how it kind of operates. So when you own a trailer park, let's say, you basically own the land, and the buildings on top of each lot, let's say, is not owned by you, but owned by the tenant, and the tenant is renting the land, and all you have to provide is electricity and running water, and that's about it. And maybe you own the communal area, and you are in charge of maintaining that communal area. So, maybe it has a pool, maybe it has a hot tub, a sauna, bathrooms, etc., and you might have some employees that work and maintain that, and that's basically what you maintain. And that's if you don't form some other kind of agreement. But for the most part, that's pretty much the low maintenance that it's pretty low maintenance. And then one of the benefits is that if your tenant, for example, just abandons the property, you basically can take that property and then sell it to the next one. And that's in the case of abandonment. Or the tenant will probably try to sell the property to someone else, and then you're basically still collecting the rent, and they're basically finding a tenant on your behalf so that they can sell the property, and they have that monetary incentive to do so because they can, maybe make something. And then there are also some speculative investors that get involved in the process that might come here and there, and it depends on the company and depends on the owner that will decide to do this. But something that you might see actually is a speculative investor who says, okay, well, there's this trashed, trailer, let's say, and I can fix it up. Or manufactured home. Let's use the word manufactured home because let me kind of just show you. So Sun Communities has actually a lot of properties in the state of Florida. Because of course, old people like to come down and retire. So you might see, like you see 55 plus, lifestyle 55 plus, signature communities 55 plus, Florida communities. So a lot of these retirees, they'll come down to these communities, and the proposition is it's a cheaper alternative. You can save more money, more of your retirement income you can spend on your lifestyle, and they're typically on like a golf property. But of course, the building itself is not going to hold or maintain its value. The value itself is in the land, but the building itself is kind of like if you've ever seen the finances of a manufactured home, you'd know. But for the most part, it's not necessarily investment. It's more of like this is a place to retire and kind of grow old, et cetera, and enjoy oneself. And then so the proposition is, of course, lower cost. You're basically only renting the land, and so they're not bad. Like there's a negative connotation regarding the trailer parks because you say the word trailer park. Well, I'm saying the word trailer park. Manufactured home community or these. Let's say mobile home communities, manufactured home communities. Let's keep it like that, because when you say the word trailer park, someone kind of thinks of, I don't know, more recent in pop culture is the trailer park in the Netflix show. Come on, Stranger Things. So there's a trailer park in Stranger Things. It's not really like that. Of course, there are some like that. And again, the quality of the trailer park or mobile home park, etc., vary, of course. And so one of the benefits of them, or like let's say RV communities, one of the benefits of them is it's really difficult to kind of get the city to create new ones. And so there is demand, and then you're there to fulfill that demand, and you can't really get much competition because it's the approval process to get a new designated land for these is rather difficult. So that's a benefit to existing players. And Sun Communities is one. You also have Equity Lifestyle Properties is the number 2. And if you're curious on what that ticker symbol is and you were wondering, it's ELS. So ELS is the other one, Equity Lifestyle Properties. So if you kind of look at their performance over the past decade or so, they were not very sexy properties to own. No one really kind of liked them, but they kind of blew up in excitement. And if you actually were involved in these properties, you've noticed probably the cap rates have been coming down over the last decade. I wasn't involved with them in the early part of the decade, obviously, but there were some deals that I was privy to, and you've noticed over time that the cap rates have been coming down and down and down and down. And so with those dropping cap rates, what cap rates is basically what you're getting as far as rental on the NOI versus what you're basically paying for. But yeah, this is a real estate video or anything like that. But yeah, for the most part, what you got to know is that over time, you're now going to be paying like a premium versus, like 10 years ago, you probably weren't paying a premium whatsoever. And I'm saying 10 years ago, like 2012, like around here. I'm not talking about great financial crisis. I'm talking maybe just after. The premium wasn't really there. So you had a benefit of both multiple expansion as well as the growth in the industry as well. There's a lot of consolidation. Well, it's very fragmented, but the two big players are Sun Communities, which is SUI, and ELS. And there's one more that I always forget their name, but they're much smaller. I think it's UMH Properties. Let me make sure, like UMH, I think is it. Yeah, UMH Properties. I think it is this one. So let me just quickly check because I think you get the highest yield, but it is the lowest quality of the two. So just keep that in mind. Higher yield doesn't equal better, even if in REIT. But let me make sure. Okay, so company owns and operates portfolio. Yeah. So it is this one. 132 manufactured home communities. So it is this one. So those are the three players that I know of. There might be another one. But then there's a lot of private players. And those are, I think, the three public ones. All right. So those are pretty, I guess, attractive at this point. All right. So I remember when my son watched Jimmy Neutron. Just trying to see if there are any questions that have come up so far. Store is the only REIT I have. We can talk about Store Capital too. No, don't worry, JP. I mean, I'm going to keep this as quick as possible, trying to get through all the topics as I can. Greetings, Tyson. How you doing? How you doing, Tyson? Let's see. Oh, you guys are all saying hi to each other. That's good. That's good. I heard you can depreciate land if you own a trailer. No. Trailer park boys. Oh, okay. Yeah. It needs to be 10 in order for it to be a buy. That's right. Kid Fleming, PhD. Yeah, the Jimmy Neutron. Wow. Thoughts on Rio Tinto? Good entry now, or are you selling your small position? Well, I already sold the position down to a small position. That's why it's a small position now. But Rio Tinto did not do well like BHP did. BHP did really, really well. We generated like about 40-something% gains on the ownership of that. Rio Tinto, we never really, but it doesn't mean it's a bad company. It's just I brought it down to kind of a watch position, and so it's kind of just staying there. I have no plans on selling that one. But yeah, so we covered those REITs. We covered the data center REITs. Let me see, what else did we cover? We will get to Qualcomm. Oh yes, of course. How can I forget? So public storage. So this is a REIT that's sexy. These are also very sexy. When I say sexy, I mean they're desirable by the investor base. So PSA is I think the ticker, and that's public storage. So these REITs have also appreciated a ton over the past, you could say, decade or so. And one of the benefits of this is they're very, very simple to build and maintain. So that's a huge benefit, especially when it comes to actually thinking about growth, right? So how do I build a new property? Well, I acquire land that's designated for the property that I desire to build, develop the property, and depending on the difficulty of the property, how much CapEx is needed to maintain that property. So for example, we talked about office REITs in the past. And in office REITs, you need a lot of money, a lot of CapEx when a tenant leaves, right? You need to redevelop that property or get it ready for the next tenant. And that's a bit more expensive than something like public storage, which you have many different individual units and you rent it out. There's not really high cost of maintenance. You don't really need too many employees running the place like you would in an apartment REIT. And so if you kind of look at public storage as a whole, as a company, it's, of course, fairly attractive for investors. It's very easy to understand. The investor base understands the business, how it can grow. And there's several players. I think, let me try to remember all these players. I have them here in these tabs somewhere. Let me put it here. So I know that I believe U-Haul also does this as well. But in public storage, you have... Gosh, okay, no, I closed it off. But there's a bunch. There's like public... I mean, I guess you guys are going to remember it before I do. But yeah, there's a decent amount actually in here. It's not like the manufactured homes space. And there's even like single-family home REITs, but yeah, we won't get... Those aren't... G. Andrews. Well, I mean, G. Andrews, I have a video on me basically buying it, and then oh gosh, I have to link that in the sheet now because I forgot to do that. There was a live stream where I go over me selling it as well. But yeah, I did hold MPW for a bit. It was a nice trade. I'm interested in MPW. There was some kind of issues I had with management, kind of trying to do something with a tenant, and it made it seem like they didn't want to disclose some of the problems the tenant was having by extending it credit, essentially. When we get down to it at the end of the day, they were trying to extend a form of credit to one of their largest tenants that's having a bit of problems right now, so they don't have to really make those disclosures. And no, they had to still make those disclosures anyways. So which is good because the investor base should know about that. But for anyone not aware, he's talking about this stock. So those of you who watch the videos on MPW know about it. But yeah, this is MPW. I talked about MPW in some good light as well. That's not all bad, but because the property types are like a double-edged sword. So you can't really build a new hospital right next to an existing hospital. It's pretty more difficult than what people really think to build a new hospital. So owning a hospital property is actually pretty good, and your tenant isn't really going to move out. But the downside is if your tenant goes BK, oh, well, there's not really many tenants that can replace that. And also gives some power to the tenant in form of negotiation. Now, that same thing goes for something like Vici. So Vici, you have, for example, well, you own the Venetian. Well, the Venetian can't just go and build a new Venetian right next to the old Venetian. They have to, well, if they go BK, then who's going to replace the Venetian? Because that's owned by Las Vegas Sands Corp. So anyways, so you get what I'm saying? It's kind of like a double-edged sword. It can be both good and bad. Oh, okay. Someone just asked about Vici as well. I usually talk about MPW and Vici in the same sentence, not because they're anywhere close to the same type of REIT, but just because I call them like they're both, the property types they own are double-edged swords. Okay. So yeah, Vici I think is still yielding about 4.41%. And MPW, I think, what is MPW again? MPW is at 8.10%. Historically, yields close to here have been good times to buy MPW. They have managed to do well over a decent period of time as far as not reducing their dividend and, maintaining it at the very least. But past performance is not indicative of or proof or evidence that it will be the same in the future. So we shall see with MPW, but yep. Okay, so the other ones that I did try to, or I want to go over, is trying to remember in the order. Otherwise, we'll kind of just wing it and go to a different stock. But we also kind of covered, we'll get to the chips in a second, Qualcomm and all that jazz, because that one's it's going to be pretty interesting, I'd say. Let me actually pull this up so when that comes. And yep, let's see here. I want to pull this one up. Okay. So okay, and I need some context here, but or provide some context here, but we're going to talk about ARM as well, as kind of a summary of what we discussed on that. Okay, going through here, let me see. All right, I already talked about Sun Communities. And let me see if there's any questions, by the way. If you guys have any questions, just shout them out, and I shall do my best to answer them as well. The local, fast-growing Uruguayan stock. I mean, we can take a quick look at DL Local. Give me some context for it. What do they do? And then I'll take a look at them. I see someone's asking about Simon Property Groups. I mean, Simon Property Groups, if you're looking for one exposure to that sector, I mean, like they own a lot of A properties. So in real estate, you have Class A, Class B, Class C, Class D, etc. And so Simon Property Group owns I think the largest proportion of Class A properties of their size, and they're the largest of their size, their size. They're the largest of their sector at 32.91 billion. So like Tanger, what is Tanger's? I think TGT, I think it is. No, that's Target. No, what's Tanger? I'll just spell it out. Yeah. Oh, SKT. Wow, that was so far off. But SKT was a far more distressed REIT in their space, and I think they bounced up nicely from that price at least. But they don't own a lot of high quality properties. They're like a little bit lower quality, and so you're taking on a lot of risk. And funnily enough, Simon Property Group yields more than Tanger. I have to check out because it's probably that their payouts a bit different, but. I would always assume that Tanger would trade cheaper than Simon, but I haven't really looked at either of them in the past, I guess, even year. I haven't looked at either. I mean, I actually know that's a lie. I looked at Simon Property Group, I think at one point this year, or a couple times this year, but not really of a focus. Now, we also, I mean, I guess we can talk about some other REITs because we're already in the I guess, vicinity. We talked last week about some office REITs, and those office REITs were, I guess, pretty interesting. There is one REIT that I am going to probably be buying soon, and I'll go ahead and discuss that here. So I guess this video serves as kind of that video where I'm kind of explaining my thought process about this stock, but I'm not sure yet if I'm going to be buying it, and I'll kind of explain why. I'm still looking into it, so just keep that in mind. So I have no idea right now. So the REIT is, I think it is, I always forget their ticker, EQC, I believe, yeah, it is. Okay, Equity Commonwealth. So I'll explain a little bit about this REIT. So Let's go to Equity Commonwealth right now, their website. They don't really own many properties right now, and I'll kind of explain. I'll stop dancing around it. I'll just explain the context. So, they're basically this REIT that sold most of their properties in the last decade and has been sitting in about $2.6 billion in cash. I'll kind of go over that real quick, financial reports. But let me just show you how few properties they have before I continue. So they have these 3 states. And by the way, sorry, 3 states? No, 2 states and Washington, D.C. over here. So they have 1 in Washington, D.C. And let's go to Texas. They have 2 in Texas. And this is very small, by the way. So it's like, what? We have 4 properties. So we have a total of 4 properties. What's the size of the company? I'll just go here. EQC. Size of the company is $2.9 billion. They have 4 properties. So yeah, it's like nothing. So remember from previous live streams, I don't know how many live streams we talked about this, but of course the liquidity crunch, yada, yada, yada. And after that Wells Fargo report, what we said what would happen to real estate in 6 months to a year from then. And yeah, we're kind of in the thick of it. So we're seeing, of course, mortgage rates rise, borrowing rates rise, cost of capital rise, and cap rates are actually improving a little bit. Not a little bit, decently actually. And so my wife and I, again, we're waiting, and we're probably going to be buying some properties soon, yada, yada, yada. So that's all repeat. And then kind of going forward on that theme is why I'm interested in something like EQC. They've been kind of sitting on about $2.6 billion in cash. Let's go to their actual financial statements, SEC filings, and I'll go ahead and show you guys on the quarterly statement. Thank you. I'm still, still doing my due diligence here, but like, it's something I'm thinking about. And then that's kind of the gist. Well, parts of the gist. No PDF. You suck. All right. All right. So here we go. Cash and cash equivalents. My eyes can't follow for some reason. There we go. So about $2.691 billion. They're down from the previous year, and I'll explain why. They've been doing share buyback. So they've been buying back some shares while they're basically been waiting. I listened to pretty much the last couple earnings calls already on this company as part of like my beginning due diligence. And one thing I found interesting was the company was basically, or the CEO and the management team was focused on repurchasing shares here and there strategically, which I like, but also trying to maintain some of the cash pile. And what they've noticed in the industry, and I agree with this. I think that this is going to happen. A lot of companies that would have IPO'd, these REITs, these different REITs owned by private investors, et cetera, they instead, or syndications, real estate syndications, instead they're maybe looking to get a private deal or a buyout from something like EQC. So EQC or Equity Commonwealth, let's just call them Equity Commonwealth. No, EQC is much quicker. So EQC's been, just sitting there waiting for an opportunity. And I think in this market, it might be now time for me to think about adding EQC. So it's just a little weird REIT that exists out there. It doesn't pay a dividend right now because technically they don't legally have to because of the requirement of the income. And so they don't have to at the present moment in time, but in some time in the future, when they do have a lot of rent coming in, they're more than likely going to have to do that. And that's kind of what they're waiting for. So I know that there is a relation that this company has to investor Sam Zell, by the way. So if I didn't mention that, someone would be like, you didn't mention this. Okay, well, I'm mentioning it now. So yeah, just a food for thought that I'm thinking about this one. I've been looking at SBRA primarily because they're nursing homes. The nursing home trade was always so overhyped in the past decade or so. I have no idea why, but you have, of course, SBRA, you have OHI, you have Ventas, but Ventas owns a lot of office space as well and research facilities. Let's see, off the top of my head, those are the ones that really come up. You also have, it's a monthly dividend payer. I always forget their name. But that's pretty much the only, LTC properties. That's one, long-term care properties. So you have a lot in this space. It's very competitive, very fragmented. And a lot of the operators are always struggling. And, by the way, so just to clear it up, I'm referring to, where's your comment? I'm trying to find it here. This one. So I've been looking at SBRA. Okay. So that's been the thesis for like the past 10 years. A lot of investors always go to these, like, I guess, conferences, interviews, or more conferences, conventions, and they'll give their speech. And a lot of these real estate guys will say, well, the aging population, nursing homes, etc. So, I mean, all that's true. Like, the underpinnings are true, but it doesn't mean that the players are going to be, well, I think there's going to be a time of consolidation. Maybe now is going to be different, and now a lot of them are going to do really, really, really well. But let's kind of go over some of them, I guess. So we can go over, for example, OHI as one. So OHI, I think, is one of the higher yielding ones at 8.30%, and its size is about 7.5 billion. But there's also, oh, come on, I just said their name. How can I forget their name? Well, we'll look at the one you're putting up here, SBRA. So SBRA, okay, they're also pretty high yielding right now, but about half the size at 3.4 billion. Not that that really matters too much, but yeah, with REITs, by the way, if you actually look at studies on the performance of REITs, the ones that are some of the best performers, it depends on, of course, the size of the REIT at the time that you're investing, because the larger it is, the bit more difficult it is to make good deals that are accretive, because it's all about having good deals. With real estate, it's the 3 L's. Remember, if you guys ever, study real estate or take get your real estate license, you'll learn the 3 L's: location, location, location. And so it's all about acquiring the best of the 3 L's and just accumulating a portfolio of those. I'd say that among my favorites is a company called Agree Realty, as far as REITs go. And they focus a lot on the investment grade tenants property. So for those of you who don't know, REITs will vary in terms of the quality of tenants, right? Because it's all about the quality of tenants. And the ones with the highest proportion of investment grade doesn't equal better, but it tends to equal better because, obviously if your tenants are more creditworthy, they have a bit more negotiating power against you. But at the same time, you're at least sure that you're going to get those cash flows. And maybe I'll also get into government rentals, because I do know some bits about government rentals as far as commercial properties go and renting out to government entities. So one thing about government entities is, like, it's a give and take. So you're going to like the initial cap rates that you're going to get renting out to the government, but later down the line, you're not going to like it too much. So there is a give and there's a take, versus something that you're renting out to private entities. You're going to not like it as much in the beginning, but like it over a long period of time more if they pay you, right? If they pay you. So creditworthy tenant, et cetera, all that jazz. And not all properties are created equal, right? Because, take something like realty income. If you talk to people who like to invest in commercial properties, one of the ones that they'll like the most is ones that are versatile. Like, you won't get as much of a high cap rate with those, but because they're very desirable and everyone wants to buy them. But the ones that are versatile and can be adapted to different tenants are going to be the best. And so think of like a Walgreens building. You triple net lease right there. If Walgreens isn't in it, you've seen probably some of them be turned into gyms. You can turn them into a bunch of things. Doctor's office. They basically, they're very adaptable. A strip mall, a little bit less, but strip malls are interesting too, depending location. That's the primary issue with those. And then you also have, well, I'm getting sidetracked on a bit of a tangent here, but you have some of the grocery store chains that actually own the buildings around them. So one company that I have a past love with is IMKTA. And this one, I don't know if any of you have been in one of their stores. I really do like their stores. I don't know if I have a jaded rosy colored glasses when I'm going to these stores, or like I've been only to the good ones, but I've only had good experiences at an Ingles market. And an equivalent, if you're in the South, is a Publix, I'd say, but I prefer Ingles over them. Anyways, so Ingles and Publix both pursue the same strategy. Publix is just privately traded, so you can't own it. So, but Ingles, a lot of the spaces that they occupy, they own the strip mall and they rent out. And so some of the things you'll see is some of the rental income that they generate. So they're kind of like a REIT, but not. And so I don't own Ingles anymore, obviously, because you don't see it in the portfolio. But it is a past love. Same with like Dell, which we also talked about Dell. I'll get into Dell as a summary, because again, if you those who missed the call, but the we'll get to Dell in just a second, but let's go with Ingalls. Oh, I got a super chat from Echoes. Hey, Echoes, how you doing? Thank you. Hopefully you also enjoy it too. So yeah, let me know how you guys like this. I guess live so far. We're basically just going off of different companies here and there. Fubo will 100x. Well, I know my father is a huge user of Fubo TV, so I'll ask him. I'll shoot him a text later and ask him about it. But that's as far as my experience ends with them. So yes, you did miss the IRM overview. So I did it towards the beginning when I went over the different REITs in their space. I included Digital Realty Trust, EQIX, and IRM. IRM, I said, is the ugly duckling of them. But, I don't know about that because DLTR, or Digital Realty Trust, is somewhere around there. But, yeah, I'd say that with Ingalls Market, you're kind of looking at a grocery store chain that operates some very similar strategy to Publix. One of the things that when I was, I guess, couple years ago, I was with a client that was actually working hand in hand with Publix, and actually some of their properties that they were developing in the greater Orlando area. And one of the things that I found very interesting was that Publix pursues that strategy. So like they'll buy, or they'll develop the land, they'll develop the property, and they'll rent out, and then they'll have even the units that you see that are dislodged or disconnected. You might notice like there's a bank in the strip mall. They'll own that too. They'll rent that out. And those are very nice properties because you basically can maybe Publix themselves will give them like a triple net lease agreement. And those are very desirable, of course, because you're basically passing on. Well, for those of you who don't know, there's single net, double net, triple net. And for basically these isolated units, you can do these triple net lease agreements and pass on all of it to them. When you're doing with something that's connected, you have like maybe some shared agreement among the different tenants that they'll cover certain percentages based off of their square footage, unless there's different give and takes between the different tenants. So a lot of times you'll notice that the anchor tenant, which in Publix's case, when they own the property, or Ingalls' case, they are the anchor tenant. So they're not making the rent, they're just generating the business profits. But if you're looking at a REIT, the anchor tenant's usually paying sometimes a lower rent than the rest of the tenants, for obvious reasons, because they're the anchor tenant. And the anchor tenant has a lot of negotiating power. That kind of coincides with Simon Property Group. If you're looking at that stock, think of the anchor tenants that they have and how that affects them. Like Macy's, you have Nordstrom, Sears is dead. Yeah. Oh, we can also talk about like SRG, which was, I think they're getting liquidated now. But yeah, SRG. I think it is. Yes, Heritage Growth Properties. So F in the chat from Monish Babrai, who sold it basically right before they came out with the liquidation plan. So yeah, serious F in the chat, as some of my friends would say. But yeah, we'll talk about HPQ. So HPQ, last time I reviewed HPQ, I think I said it was like not overvalued, but like it could be a value trap. There's HPE and HPQ. So HPE we'll get into as well. So that was one of the discussions. And actually, this would be a really good segue into Dell to kind of review what we talked about with Dell. So HPE does a lot of, or HP Enterprise. Ooh, Enterprise. They offer a lot of services regarding cloud solutions, not the cloud service provider, but the cloud solutions like, different equipment necessary for performing those actions. And a lot of people like HPE because, okay, it's a value. PE, look at that. PE of 4.73, dividend yield of 3.63. I have no experience investing in HPE, so I've never held HPE in my portfolio. I did hold its competitor, Dell, which actually went through a split, and that was something I realized in the call because I was like, dang, it's like basically at the price point that I bought it at, but I was like, that's weird. I don't remember it, collapsing like that, but it's because they went through a split, by the way. And so I originally invested in Dell Technologies for the ownership they had. This is not the case today, so keep that in mind. Had in a company called VMW, which I'll show you in a second here. So at the time, and this was around 2019, 2018, 2019 I think was one of my involvement, but VMW was, I almost think like I'm talking about Volkswagen when I say VMW, but VMware. They owned about 80% of VMware back in the day. And so if you guys were investing in the past 5 years, maybe you remember this, I don't know. But yeah, they owned about 80% of VMware, and at the time you could have been buying Dell, and the 80% ownership of VMware, and VMware was publicly traded, the other 20% was publicly traded. You basically were getting the entire value of VMware in that 80% ownership, and then the rest of Dell for free. And by the way, and then some, because I think the 80% ownership of VMware was worth more. Now, there is the caveats that, okay, well, you can't really say that the value could be necessarily realized in a liquidation event, because it's a bit more complicated than that. But if there was an eventual spinoff, which story turned out, yes, there was, then there was a potential gain to be made. And then had you pursued that trade, you did really well. You did really well, because you got the shares of VMware, and then you got the appreciation from Dell, and you were able to kind of just take that out. All right. I think for me, I got out my involvement before the actual spinoff of VMware. I don't know if it was a spinoff and you got the shares, or they just sold the shares of the company. I really forget. It's been a while. But anyways, that was VMware. Well, not VMware, Dell experience. So that's my past love. And then so HPE is the competitor. So I don't really think their main business, the Dell's main business, which again, I didn't want to own Dell for its main business. I owned it for that specific reason. And so after the realization of that, I was done. I wanted out. So HPE, I'm not really attracted to it for that reason. But your question was on HPQ, because HPQ, I think I have a video on this. I think I have a video on both of them. I think I did both of them simultaneously. And my opinion was, and actually, this is a good chance to check it out. So I'm going on my YouTube channel, as you guys would do as well. And I'm going to go Capital Mindset HPQ. Let's see if that pops up. Yeah, I did. Okay, so I did one 4 months ago. And yeah, it was a subscriber request that I fulfilled. And let me see. Pause there. Basically, oh gosh, the quality. Why is it not? It says it's HD, but it's not discounting HD. This thing. All right, let's see. Okay, now it's good. All right, yeah, and I did not like it, and the price was $38.50. I have to remind myself, so because I can't remember everything I say. Look at that creepy smile I'm doing. Look at that. Look at that smile. All right, but yeah, I think at some point, basically you can go through my summary. I didn't really like it. And then so people were asking about this. I bought this last year, 26. So yeah, I won't dox anyone's comments, but yeah, you can go check out this video on my thoughts. But I don't think anything has changed. There's just a lot more that you really do have to think about regarding this company. Okay, so that's HPQ, and yeah. All right, what else? I sold HP after my second laptop. Bought them from Bricked itself in less than 3 years. HPQ, yeah, HPQ is a value trap. I think that was the actual words used in that video. I have another value trap video that I filmed last week that's going to be coming out. So I came out with ELS, which is a company that oh my gosh, Nicole's trying to bring it into politics, I see. But I talked about ELS as an update, and that was a value trap. So that one, go ahead and that was a pat on the back video, I guess you could call it. But at the same time doing that update. But no, sorry, not ELS, NLS. Oh my gosh. So NLS, Nautilus. And so at the time I made the video, it was like $5.80. And you got to understand that, when Everything Money was making a video that was pretty positive on it, it was around $15 a share. So at the time when I made this video, you have to understand that, let's say from peak to trough, it was down, I think it was like 67%, 70% almost. And so in order to come up with an opinion that the stock was going to go down even further, is kind of like, well, you're following, I guess, trend there. But there were some comments that were deleted because the comments were actually in towards the negative of my commentary. Because my commentary is basically how investors were using the cash pile. And if you go on websites like Seeking Alpha, you'll see that a lot of articles were written about the cash pile. The cash pile is like your safety net or implied safety net in the business. And I think at the time the cash pile was sitting at like $100-something million. And if you look at it now, it's like $7 million. And the reason why is if you looked at the cash pile growth, it happened during the pandemic when there were a lot of inventory issues. So, you just put two and two together and you kind of realize, okay, well, they're probably gonna have to spend on inventory. Right. So if they're spending a lot on inventory, that cash pile is going to come down. And then you're making the assumption that they're going to, sell it all at a good price and revenue is going to continue on into the future. And revenue kind of fell back down alongside with something like Peloton. So yeah, that's the story of NLS. But the other one that's coming out is Sleep Number. I'll release that sometime. And then I made a video on 3M last Sunday as well. But yeah, that's kind of it. They make them pay $50. I mean, that's $50 an hour. Oh, it's very good. Let's see here. Trying to see if anyone asks questions. Thoughts on OTEX? Just dropped like a raw Canadian software company that Julius and I were looking into. Love to hear your thoughts, Dad. Okay, I have a son now. That's a lot of pressure now. OTEX. Let's see this. OTEX. So Open Text Corp. All right, $8 billion company in Canada. Already market down. I'm kidding. Market down as for being Canadian. All right, in all seriousness, let's look at this. Because Canada has some gems in there, but, I'm guessing this is some sort of customer support. Open Text acquire... Micro Focus, Open Text Cloud, Partners, Alliances, Developers. Okay, what do y'all do? Business Network, Content Cloud, Experience Cloud, AI Analytics, Security. Oh, I'll also kind of discuss something I'm going to plan on doing. I'm going to create like my own personal index of sorts, but for specific strategy. All right, so let's I guess look at their stock. So it recently fell off a cliff. That's the context. All right. Oh yeah, just like boom, done. All right. What happened though? Okay, so they're basically at the pandemic levels. Wow. Okay. So this I'd have to put down on my list if I actually wanted to see what's going on here. So underperforms. I love this. Market Watch 3 days ago underperforms the market. Yeah. Okay. So let's go on the Motley Fool's website. Why not? What could go wrong? So what? Open text. These AI generated articles. They're so funny. So much value provided by them. So much value. Okay. So what is this? UK's Micro Focus shares nearly double after Okay. So basically they're okay. So I'd have to really look into their acquisition of Micro Focus. All cash deal. Oh, okay. So it's not really going to be. Micro Focus shares soared nearly 92% early. Okay, so it's all cash. So what, are they going to destroy their balance sheet? Is that what's going on? I bet you that's what's going on then. The market probably just doesn't like this acquisition. So are they empire building or are they doing something that's actually accretive? So like, for example, one of the companies I own, GPN, and I think is still doing okay in terms of returns this year. I think just okay. It was doing better, but now it's just okay. So they're a serial acquirer, but most of the time when they acquire something, it tends to be very accretive or so I actually like, I'm more confident in their track record for acquisitions. I don't really know much about what this other company is doing, so I'd take a look. But my opinion right off the bat is going to be anyone looking into this company has to really look into this Micro Focus acquisition. Is it a good acquisition? If it is not a good acquisition, your own personal opinion. And then how much risk are they piling onto the company in this acquisition? Another company of mine that's doing an acquisition right now is Celines. And this one, I'm just like basically building out the position still. It's of the chemical companies, going to be the one I'm going to build out the most. And I think the other ones are Dow. BASF is like speculative, but not speculative. It's not speculative, but it's like, small. It's going to be the smallest, maybe it was the size of Dow. I don't know. And then Celines is going to be the one that becomes the largest for me. Oh gosh. I mean, if you want to, you can always just DM me privately. I won't say it's from you. And if you want, and I can. You can just DM me on Instagram if you want. If you want to share. If you don't want to share, that's fine. I don't really mind. Other people have shared me DMs of other people, other creators. It's really funny. But I always keep people's identities confidential if you want it to be. If you don't want it to be and you're saying, please, let everyone know who I am, I also is fine. I prefer free the nip. What is going on here? Okay, so Warner Brothers Discovery look now too messy. Warner Bros. Discovery, I mean, my opinions haven't changed on Warner Bros. Discovery, really. It's not going to be like the next Netflix. It's its own thing, and it's going to compete alongside Netflix. But Yeah, the risk is just the same as it always was, the debt. None of the risk has changed. The videos I made, even in the past when it was just discovery, haven't really changed. The market, I still believe, has to digest this new company, and it might not be to let's say a good result, a good opinion. They might believe that it's bad. And so I think on the latest video that I made on Warner Bros. Discovery as a combined entity, I think I increased my required margin of safety to buy more shares. But I'm happy with my Netflix holding, but I'm not adding my Netflix holding. I think Netflix has ran a little bit too much. If it comes back down, that's a different story. So yeah, that's with that one. Okay, so Qualcomm. I want to get to Qualcomm. So if you guys don't know, so Qualcomm had acquired, and so this is again a summary of the conversation we had. But let's see here. Well, Elliot just asked a question. Let me. And by the way, I don't mean to skip anyone's questions. If I skipped over your question, it's just because a lot of comments come in, and it takes me sometimes down to the bottom. You can re-ask your question. I'll get to your question. What are your thoughts on being a content provider for a streaming service rather than providing the service? It seems like Warner Bros. Discovery are going for this method. Also, Sony, the same with music and content. I mean, you don't have to... Yeah, I feel like the content itself has a more tangible, realizable value. So when we talked about the streaming companies, and if you ever hear anyone say this, you know, they watched my videos, but they have a recapture moment. And so a lot of the content providers have this recapture moment where, like Disney, for example, they produce a movie, they spend all this money on the movie, and they put the movie out in theaters, and they have this recapture moment where they can regenerate income from that content that they spent. Netflix provides, like, for example, actually a show that if you haven't seen and you're a fan of DC Comics, go watch The Sandman. Very good show. I think it's a very good show, but that's my opinion. Very good show, and produced by Netflix. I'm almost like, I'm frankly upset that I can't say that. I almost said something I can't say. That was close. But anyways, certain shows out there produced by certain companies, I almost wish they didn't produce those shows. But as far as Sandman goes, or, you know, The Witcher, I think I really like what Netflix has been doing. And I know you might be saying I'm biased. No, but I would say if Netflix produced a bad show, and we were talking about that show, and I think the show is bad, I'll tell you the show is bad. I mean, Netflix has produced a lot of crap as well. But as far as the Sandman goes, that's an example of a very, very costly production that the realizable value is very difficult to measure. So even the producer of the show has talked about how expensive the show was, and they haven't been yet approved for season 2, as far as I know. So I wish there was, but yeah. I wish Netflix got rights to another show or another content that is being produced by someone else, but it is what it is. And which is kind of weird because the other content creator has made some good stuff too, but just with this, they kind of just, my opinion, not going to do it a good service, my opinion. But as far as Disney goes, I can be open about Disney. Screw Disney. I do not like what they're doing with Star Wars. I'll tell you that. But whatever. I think Disney is a serial acquirer of IP and destroys IP. But Disney is also the type of company that the IP they have, there's always the fan base that doesn't really care too much, and also maybe they're like more casual consumers. So Disney's always going to do good, I think. But as a company to invest in, my only issue with Disney is the potential of that. I know it's like a long shot, but I don't know, man. That whole fraud shtick they got going on potentially, allegedly by the that individual, as an investor, makes me kind of go, I don't know about that yet. So yeah, but Disney, I think, will do well. Besides that, Disney will do well over time as a company. I don't know about the stock. All right, so let me go over some of these. Let's see here. I subscribed for Peacock for Premier League. I mean, yeah, you see, that's how they'll get you. They get you for one reason or another. They're like, hey, you have a reason to come here. Is it inherently negative? No, it's not inherently negative. It case by case basis is what I think that should be attributed to. So if you're a serial acquirer, maybe you've been doing really good at acquiring things. And I'd say, are you buying things in your circle of competence or like your main business line? So Rick, you guys love Rick, right? And Ricky, you love Rick, right? So I'm going to assume you like Ricky. I know Julius likes Rick, but you might like Rick. But anyways, sorry to presume. But Rick's been a serial acquirer, but a serial acquirer of what? Oh, by the way, when I said you like Rick, I meant the company, not the establishments. But I don't know. I have no idea. So if you like the company's a serial acquirer, but they're a serial acquirer of clubs, and they buy more and more clubs. But what do they mainly do? Well, they operate clubs. So, of course, right? And so GPN is a serial acquirer, but they acquire things within the fintech space, all kind of building this ecosystem. So it's all blending together. You got to look at this company. What did they acquire? Is it something that adds they can tuck in? Like basically, what you want to make sure is it's not like a GE moment, like you make washing machines. I'm just making something up. You make washing machines and you buy a bank. You see that? Like that's what you kind of want to make sure that the company's not doing, because then you have a more probability of failure, let's say, than success. But a company that's buying other companies in its vicinity could just be consolidating, creating new value for its existing customers, etc. Anyways, I was getting into, well, I don't want to skip anyone's questions, but let me see. I'm subscribed. Okay, just kind of going through, making sure. Fringe character She-Hulk was in the comics, always kind of a freak. Yeah. You need a finance washing machines? What does that mean, finance washing machines? You mean like take on debt for washing machines? Okay. Or you mean like money laundering? I don't know what the reference is there, but it could be. AMD's acquisition of Xilinx is a decent example of using overpriced. Yes, it is. Exactly. So AMD is a company that is making good moves in the future to kind of get out of the eventual change out of x86 architecture. So I am by no means an expert in this field. I'm kind of just repeating from what I've learned, by the way. So just keep that in mind. So the future in cloud is eventually going to move into ARM architecture versus x86, and the Xilinx acquisition kind of helps AMD navigate that change over time. People in the Discord, not me, people in the Discord or in the community have done or given really good insights on NVIDIA and shorting NVIDIA, actually. So I thought that was very valuable insight, by the way, because it came from a deeper understanding that I do not have, just to let you know, because I'm not, I don't work in that space. But yeah, I thought it was interesting, to say the least. And so that kind of segues into Qualcomm, because I wanted to get into Qualcomm. All right, so Qualcomm is an interesting company that might provide an interesting opportunity in the future, to the detriment of companies like Intel. Okay, so it all begins, and I'll kind of form a narrative here. And so this is kind of the summary of the call, but a narrative. And this is the TLDR. Okay, so it begins with a company called Nuvia. Okay, so gather around, children. Stefan Hoff, I sold out of Magna because I was just cleaning up. So in the video where I talk about selling Magna International, which I don't know if I have the video linked. I got to do some cleanup and go back and link, because I think there's a couple shares or trades that I don't have the link provided for the video of explaining my thought, but it is titled, and it's actually a more recent live stream where I go over all the stocks that I sold recently and why I sold them. And it came out the day I did it. But I think in the portfolio sheet, I don't think I have those linked yet. Yeah, I don't have them linked yet. So the MGA was talked about in that video, but the TLDRY, I was just cleaning up, and I wanted to clean out the portfolio a little bit. I sold the banks on the same time frame and talked about in the video. Sold BBQ Holdings, one of the speculative holdings, took profits there. Sold EGAN at a loss, and sold MPW at a profit as well. I could basically rebuy MPW basically at the same price, because my original cost base is $14.78. So anyways, that's basically it. Not that it's a terrible company. I foresee terribleness. Look at that 3M sale though. That video is linked there. Why I sold 3M. We made a 1.85% profit, and 3M is now trading far lower. But it was a small position. It was a very, very small position. Okay, so I'm a genius. No, very, very tiny position. It was a watcher position in the first place. So, but yeah, 3M. There's a video on that coming out. Anyways, don't want to get too distracted. I wanted to talk about Qualcomm. All right, so you need to know about a company called Nuvia. So Nuvia is formed from a group of experts. And again, I'm kind of repeating a lot of good insight that was provided in the community. So Nuvia is kind of going on as this acquisition that Qualcomm got. And Nuvia was formed from former engineers at, I think it was a variety of companies, but the main one we want to focus on is Apple. So you might know Apple's new silicon is really good, and a lot of those guys who are responsible for that production, come from Apple. And so Nuvia is now owned by Qualcomm. There's a whole thing going on with ARM. This is public information. Here you go, just this ARM lawsuit going on, licensing agreement. So I'm going to be paying attention to that. But TLDR, Qualcomm's looking very interesting. Because the lawsuit's probably giving us a little bit more insight into the actual threat that Qualcomm Silicon will actually have in the future. And so ARM, I don't know, we don't know what they're doing. It could be to slow it down, but yeah. And there was a bit of interesting behavior from Qualcomm and ARM and what they did to ARM, but yeah. So the lawsuit alleges some things, but. Yep, that's basically it. Qualcomm is interesting. That's the summary of what was talked about. In more detail was on the call, but summary what the TLDR there. Okay, so Austin. I forgot it's Labor Day. I don't celebrate Labor Day this year at least. Yeah, Qualcomm and China. I wouldn't. The China risk is probably like why investors are paying attention to, but I don't really think. Like there's a point where it's going to be priced in, and all these crazy, ridiculous videos of China economy collapsing in something days. I didn't jump on the hype train, guys. And me, I have plenty of negative things to say about China. Just go look at the not detailed, but huge list on the content library of China videos. And remember, I made the pledge to not talk bad about the VIEs until they go up. We made that pledge, I think, back in March or February of this year. So I haven't made any VIE-specific videos. But if you guys are new to the channel, I have lots of content on VIEs. I know some of you, my subscribers, are invested in the VIEs. And, yeah, we've gone back and forth on them. But, yeah. Okay, so Fabio, and why Qualcomm might be worth a look. We need a little backstory. Qualcomm has established in 1985. Yeah, let's go all the way back. All right, but basically the new silicon it can be pretty much a really big threat to Intel. They're trying to get into the CPU market, and we'll see how that kind of pans out. But yeah, I think Intel is Intel guys is I mean, now that Intel video is aged really, really well. Let me pull up the actual Intel video, because you know what, guys, I gotta brag about it at this point. So let's go here. Capital Mindset Intel. I think it was almost an hour-long video. The one. Oh no, it wasn't an hour long. Oh, I remembered it incorrectly. So hold on, which one is it? I think it's the 4 month ago. Yeah, it was 40 minutes. No, that is very 40 minutes. I think it is this one. Okay, let me see. Is this the one I go into? Yes. Yeah, it is this one. So it was posted on April 30th, 2022. What was the price of Intel then? Curious. Oh no, it was 43. All right, not as good. There were the other videos, I guess before then, when I was still negative on Intel. So not as much of a pat on the back, right? But still, $43, $31. That was probably like my most negative one. But there were other ones, I think, in the 7 months ago. Yeah, I posted this one 7 months ago. Oh, no, just play this one. This one was posted January 30th, 2022. That was another pretty negative one. I want to see what Intel was trading then. I don't know why I'm wasting my time. I can see what Intel was trading then here. Why am I zooming into the video part? January 30th. What was it? Where's January 30th? Where are you at? Yeah, $48. All right. $48. I remember what triggered when I briefly owned Intel, and it triggered my sale when they were, doing that whole shtick with Mobileye, and I was like, all right, this management team does not have what it takes. Was my opinion back then. And then, you had other larger YouTube channels kind of going off of the cash flows, but not understanding the R&D expenses that were going to basically annihilate those cash flows. So your valuation models were off. But anyways. That's much. I'm not really going to say much about Intel. Still reinvesting my Intel dividend. Shout out to Strongman 3M too. I think they'll survive the lawsuits. Okay, so 3M I think might survive the lawsuits. Intel will survive as a company if they make the necessary adaptations. I think they're going to go more into, maybe a fab service provider than anything. But yeah, that will be said. Kind of nervous about China relations, Taiwan Semiconductor. Yeah, well, there's a lot of things to be nervous with Taiwan Semi, but yes, Taiwan Semi, you have that political risk, and a lot of the Discord members, they have that concern as well, so you're not alone there. GE, wow, I haven't even checked out GE in a long time. What is GE even doing? All right, so GE. Yeah, they did the reverse split. I remember that. Yeah, they're still on that really slow trajectory downward. Are they still at the risk of bankruptcy? Is that still the overhang that people are talking about? I don't know what even people think about GE. I haven't looked at GE at all. But yeah, look at that. What is BP doing here? Let's see. BP is it's done terribly. Well, I mean, yeah, their reserves still. BP's been a horrible company. Let's say with General Electric. Look at this, guys. Look at that. General Electric, 1,000 returns from the max, not excluding dividends. Okay, so after 8 years of GE, finally did a tax loss harvesting event. Well, tax loss harvesting, there you go. At least you got a benefit out of it. Okay, so CRSR. Don't get me started on CRSR. We talked about what's CRSR been doing. Haven't checked out the. Oh my gosh. Okay, they're at $14. I don't remember the last thing I said. I think the last time we said the price would be interesting at around this range. Huh. I'd have to revisit it because remember there was a lot of demand pull. So they're finally at this price, and maybe it would be time to revisit them. I just don't have time to revisit them. There's other companies I'd rather spend my time looking into and doing a video on. I think you guys would also prefer another video on a different company. I don't know if you guys want a Corsair Gaming video. Oh, Comcast. Comcast is one that was being asked about. I'll talk about some of these. So CMS. Comcast is CM. I'll just type. CM CSA. I think is Comcast. There we go. So Comcast has basically come all the way down this year, down 29%, down 40% in 1 year. Look at that. Basically getting back to below pandemic levels here, or at pandemic levels, sorry. And you're getting a high yield historically for Comcast. I think some of the concerns, I haven't looked at it yet, but legacy business slowing down, all that jazz. They have the content media. I mean, if you don't know, they own MSNBC, CNBC, all that jazz. They own Universal Studios, the parks, and then the network itself. But yeah, Comcast. Okay, I'll do a video on Comcast because I've been wanting to do a video on them. They've been requested as well. There's also Bristol Myers. What was that? All right, Bristol Myers Squibb, BMY. So BMY is a company that I sold, and I bought Cardinal Health. Some of the proceeds went to buying Cardinal Health. But when I made the video of me selling, this was Capital Mindset, I think sub 1,000 subscribers. So this was 2021. In that video, when I had my ex-co-host Austin on, he kept the shares, I sold the shares. But I sold the shares saying in the video concluding that I'm not selling because it's a bad company. I think it would do well. And it did well. It proceeded to do well over the a specified time period because I think now it's given back some of those gains. But yeah, it's done well since around this time frame. So, because it was like towards the end of 2021 that we did a video on it. And then the other one that, we also talked about for a little bit Walgreens and CVS, but I don't know if you guys are interested in that. What about CRM? So CRM is another company that, I don't know what can't get to the M. I guess I'm looking through the glass and it's distorting my vision. Yeah, no, if you're holding BMY for that income, for that yield, there you go. It's doing its job, and it's going to keep growing the dividend probably for long periods of time. And the pipeline looks pretty good. There's nothing, dangerous about the pipeline that I see. Like Novartis has had like no growth whatsoever. If you actually look at Novartis, and I think it's NBS and something like that. But yeah. Market is screwed until then. P. Morton, that's not printing money. That's my only trigger. Okay, guys. By the way, I'm gonna shamelessly shill the like button. If you guys want to, go ahead and like the video. If you guys want to, all right. You guys don't have to. I won't feel sad. I'll just feel a little sad. All right, but anyways, on all seriousness, Salesforce. All right, so Salesforce is the company. I think their growth has been slowing down, and it's reflected in the share price. Remember when this stock price was hitting like 300, guys? All right, but now it's basically back down. This is a company that has bragged decently about the growth that they'd achieved relative to Microsoft. I think Mark Benioff has compared them to Microsoft several times. They own Tableau, which kind of good comment actually, because this segues into something I'm going to plan on doing for myself, for fun, and I'm going to use portion of my retirement portfolio in order to do so, to kind of forego the tax events, and then I might do like update videos on it. But I'm going to create like a quasi, I don't know, makeshift index fund of SaaS companies, B2B, because that was actually a topic of the call as well. So this is a good segue. And in general, I don't know if you guys know, this is my opinion, but B2B SaaS companies are very, very difficult, because at the end of the day, your customer, your consumer, your end consumer is a business that is always looking for efficiency, cost reduction, etc. And so as soon as you have a good product, what's stopping someone else from developing a really good product and competing against you? Well, that's a good question. And the answer is, well, not much. Like, okay, so you have an edge. And so, the next guy is always trying to get a better edge over you. And if they do achieve a better edge over you, well, hopefully your switching costs are high, right? And that's the moat that you can develop. So CRM is always going to be fighting wars on all fronts, because they're very large and they offer a lot of services. There's always a smaller player who maybe has a superior product. And then again, as an investor, you hope the switching costs are high enough that they don't switch to that better alternative. So for example, if you have Tableau, well, you have Alteryx as an alternative. And there's plenty of large enterprises that use Alteryx or have switched from Tableau to Alteryx. Okay, so Alteryx ticker symbol is AYX. And Tableau no longer trades because it's acquired by Salesforce. Then you also have, like, for example, Slack. You also have to worry about larger players that have a strong moat already in their product. So, for example, Microsoft Azure, Microsoft Windows, Word, Excel, all that jazz. And then they just create something called Microsoft Teams. And they're like, okay, you're already doing business with us. You already have a business license with us. Why not just use Microsoft Teams as well and, cut out Slack? So hopefully that switching cost is high, all right? And again, like with data analytics, you have Tableau, Alteryx. You have another player out there. I think it's Domo. Domo is another one. You have Datadog, which is a different one. You have PagerDuty. Datadog being the best one. I think PagerDuty not being the best one, but the smaller one. And then you have as well. You also have cybersecurity as, I guess, software protection. You have Cloudflare, CrowdStrike. NetEase, no, wait, not NetEase, sorry, forget that one. Fortinet, sorry, I was thinking about Fortinet for some reason. Palo Alto, trying to remember more of them. There are definitely more of them. Checkpoint, which is the garbage one, but Checkpoint it was the best value. And actually, for that time period when we did the video and we said that it was the best value, it performed the best and actually appreciated while the rest of the cybersecurity stocks did go down. If you guys are curious, go check out that checkpoint video and then map out how it did. But a full understanding that it is the lowest quality. And if you talk to people who work in the cybersecurity space, they'll even tell you like checkpoint's kind of you can even look at, consumer reviews from companies on checkpoints, like, but it was the best value at the time. And its value proposition or its value as a company versus like, your margin of safety made it so that the other ones are so much overvalued that it performed the best. But yeah, that's an example. So I'm going to be kind of I'm going to be using M1 Finance, just why not? Because I don't really have an M1 Finance account. I have a very small amount of capital in my M1 Finance account relative to the rest. And so I'm going to be using M1 Finance, so it's just separate. And I'm going to think of it all as one position. And then I'm going to try to, create some metrics to decide how I'm going to weight the portfolio. I'm probably going to do like a market cap weighting and simply use, and I can rebalance it because it's going to be in a retirement account or it's going to be a portion of retirement funds. And I'm going to see how it goes. And then I'm going to create like criteria as to what allows a company to get into that quasi SaaS index. But again, it's just for fun, and it's going to be seeing like, because again, B2B software is really difficult. Like we were talking about some companies that I don't know if you guys know even exist, but Blackline's really good for accounting software. Bill.com was one that we also talked about as also being very good, convenient, easy to use. You might be, of course, familiar with Intuit, with their different softwares that they offer, like QuickBooks. QuickBooks is more like small businesses, really small businesses. I'm trying to think of some other software companies that we might have talked about. But yeah, CRM being a very large B2B enterprise company is basically fighting wars on all fronts all the time. So Domino's Pizza, so DPZ, how have they been doing? Let's see. DPZ, so 365. Yeah, look at that. Oh, yeah. My wife's like, salmon. She's just she showed me a note. She's like, salmon. Because we bought salmon the other day, and we need to eat the salmon. I'm curious. How do you say salmon? Salmon. You know how I used to say it? Salmon. Yeah, I know, because in Spanish it's salmon, and so I would say salmon. I know. Make fun of me, guys. Make fun of me. Salmon. That's how I used to say it. Just in case you didn't hear me. I used to call it salmon. All right. So how much I have no idea how much salmon costs. I don't know off the top of my head. That's an inside joke now between Cole and I guess. Salmon Brothers. Yeah. You know what? Hey, Cole, tell you what. Get experience at that bank. We'll start a bank. We're going to start a bank. We're going to call it Salmon Brothers. Let's do it. I'm serious. Let's do it. We'll start a bank called Salmon Brothers. We'll start it in 10 years' time. All right? We'll be the most reputable bank ever. We'll only lend to, high credit-worthy whatever, and we'll charge really low yields, and we'll be Salmon Brothers. All right? You had your favorite pizza from the place in... Nice. Yeah, that pizza place is going to do really well. All right, so... Okay, Cole. we can be the wokest bank in the world. That's fine. I just want to own a bank called Salmon Brothers. I think that would be hilarious. And then we basically we're the only two employees too, and we offer yields exactly at the rate of what we lend. So we have no margin of safety in our loans. We're a people's bank. On top of that, we make no profits. And we go public at one point. We have tons of revenue growth, no profits. We'll dilute our shareholders a ton, and we'll always err on the side of like legality on all these things. We'll definitely do that. So there you go. That's the plan. And then we'll always be like, we'll have the pat on the back slides, every investor presentation, like look at our ESG score. We'll have like an S rank ESG score. That doesn't even exist, but we'll have an S rank. They'll make one just for us because the bank will be so great in ESG. But yeah, let's do it. Salmon Brothers. All right. Let's see that. My favorite long duration company is ChargePoint. As my thoughts, Biden recently appointed the CEO to his committee. That's interesting. I did not know that. I mean, ChargePoint, I think electric vehicle infrastructure is getting better, a lot better. I mean, just on the way to Miami, I noticed that you could take a Tesla down from, basically the whole duration to Miami. It's pretty nuts. You have plenty of charging stations, fast charging stations, by the way. And by the way, to fully fill up a Tesla, it's still way cheaper than a car. So I think when I did that Tesla analysis a long time ago, I actually was very conservative, and I just basically assumed everyone was going to spend the same amount it would cost to fill a Model S. I think a Model S is like 20-something bucks to fill up fully. So yeah, but yeah. CVS is acquiring SGFY. Oh, really? Well, anyways, this is a good segue into CVS versus Walgreens Boots Alliance, which, by the way, one of the topics that we had in the call was CVS versus Walgreens Boots Alliance. And over the duration that I did hold Walgreens Boots Alliance, my thesis was that Walgreens Boots Alliance would perform better. Over the duration that I did hold Walgreens Boots Alliance, I was correct. But this is where I'm being a little picky. I'm technically was wrong because CVS, their purchase of that insurance company, and we've talked about this in the past, but I'm just kind of emphasizing that again here in case you didn't see that. But so technically, beyond the duration of which I owned it, I was incorrect. CVS's acquisition turned out to be good for the company because during this liquidity crunch that we experienced, and we're still in the midst of, CVS owning that insurance business, and let me show you, like if you haven't seen, well, you guys probably are very aware, if I just put WBA, Walgreens Boots Alliance, you'll see how much the performance has really separated between the two. So yes, if you kind of look at over that 5-year period, so during the duration of around, I think it was around here to here, if you map out that percentage increase, it was more in Walgreens Boots Alliance. But going past that point, Walgreens Boots Alliance began to underperform while CVS actually started to do really well. Going forward, I don't know. I don't know where things are going to go because I haven't really been paying attention to these companies. But I know that some of you own CVS and are just basically holding CVS and enjoying that dividend with the new enterprise that really you have to really look at it because Walgreens and CVS are now two different companies. They're honestly two different companies. So Walgreens is basically a pharmacy that went the partnership strategy where they're just building out partnerships. You can see that even on a PE multiple, one's trading at like 3 times the other one. And so Walgreens, my gosh, is at 35. It is below when I bought it way back when now. So, yeah. And now they don't have that, vaccine catalyst that they had before. CVS having this diversified business model seems to be a strength right now. But you see, it's diversified within the same realm. So Walgreens goes with the partnership route where they have ownership in AmerisourceBergen, ticker symbol ABC, which I guess I apologize if it seems like ranting or going off into different tangents, but they're connected, I swear. So our AmerisourceBergen is 20-something% owned by Walgreens Boots Alliance, and this came about because of deals over time that they've had. And I own Cardinal Health, but Cardinal Health should be noted, and Cardinal Health has done really well this year. One of the best performers in the portfolio this year. So year to date, it's done phenomenally. But all 3 of them have done phenomenally. I think McKesson, AmerisourceBergen, and Cardinal Health have done. And Cardinal Health is the lowest quality of the 3. McKesson being the best quality, AmerisourceBergen being below that, Cardinal Health being the lowest. But it's a triopoly, essentially. And I know that Cardinal Health does a lot of business with CVS, by the way. So fun fact. So I should know that if I am invested in Cardinal Health. Cardinal Health does a lot of business with CVS. And AmerisourceBergen does a lot of business with Walgreens. Go figure, because Walgreens also owns a big portion. McKesson also does business with, I think, both. But, yep, that's pretty much what I wanted to cover with those. But, yeah, AmerisourceBergen, you do technically get some ownership exposure with Walgreens Boots Alliance. If you didn't know that, now you know. And it's funny, but, yeah. All right, so let's see here. Salmon Bro sounds like a fishy proposition. That is a good joke. That is a good joke right there. All right, so let's see. Let's see here. Who's going to provide custodial services? I think I'll leave that over to Cole. Cole will provide custodial services in Salmon Brothers. Well, We'll provide maybe like you know how they used when you opened a bank account, they used to offer you like, I don't know, like a pen or something or a mug. Maybe we'll offer you a salmon, like literally just a piece of salmon, and we'll be, here you go, here's a piece of salmon. Cheesy glasses, man. By the way, Fuhat, you know, I found out recently because I pay attention. Don't worry, I pay attention that you've never made lasagna, being a culinary chef and all. This bank will have an asset management division. Dan Wesson, thank you for asking. So that will be we'll take your assets and we'll just shove it into, again, Cole's going to manage the day-to-day, so he's going to put into some call options expiring 1 week out into the future. So that's basically the strategy, and we will tell our clients that we are FDIC insured, but we're not. But we'll tell them. Super illegal. But, yeah, you know, it is what it is. All right, in all seriousness. So, yeah, that's pretty much it as far as the pharmacies go. We did talk about CVS and Walgreens Boots Alliance. I think, like, my gosh, guys, it is looking so cheap, but it's cheap for a reason. What is this? Oh, gosh, get out of there. But, yeah, it's looks cheap. I know a lot of dividend investors really like this. I mean, 3M's going through some similar. Look at that, basically. yeah. Watch it moon like this. That'd be so funny. All right, but I'll take a look at Walgreens Boots Alliance because maybe there is something there. I don't know. Maybe there's something there, but you know, you could be just catching a falling knife here and then cutting your hands there. So it feels like with Intel. Cisco is also another one that's down. Funny that they're all put together. I'm guessing they're all put together here because a lot of, not CVS, sorry. Let's go back to Walgreens. Let's get rid of you. So, what was that? IBM? Was IBM in here? Oh my gosh, there is a familiarity between these. I wonder what is so familiar about these. These seem to be companies that these dividend and growth investors really like. So Citigroup, I know a lot of people who like banks, they'll choose them because they have the highest yield. Don't do that. But they're not a bad company, but don't do it for that reason. Try to get in there and understand the intricacies of their balance sheet. Altria, yeah, that's similar. Altria is actually one of the best performing stocks of all time, by the way, with reinvested dividends, excluding taxes, I think. I don't know if you include taxes. Is that the same case? Verizon's come down a lot. My gosh. Yeah, let's go to Verizon. Why not? I'm getting distracted here and going on so many stock tangents. It's not even funny. You guys might think I have ADHD or something. All right, so dividend yield is 6.20%. I remember, I think I have like one video on this and it was pretty negative. Let's see here. I'd like to go ahead and open an account with Salmon Brothers. Where do I send all my money? Okay. I mean, I guess you can email Cole's account. I think it's something Diamond Hands 6969, something like that. I forgot. You got to ask him. Jokes, of course. Healthcare company is mRNA. Moderna? Oh, yeah, Moderna. Well, there's also that other one with a huge accounts receivable account. mRNA. Yeah, that's Moderna. Moderna. With the vaccine, Moderna. What is that one that with the high accounts receivable? People were like having a hard on for that company. Oh, BioNTech. There you go. So you see, like, it's so funny. I'm thinking of it, and the Google's like, are you thinking of BioNTech? And I'm like, yes, I am thinking of BioNTech. All right, so here's BioNTech. So BioNTech, this is a company that a lot of people are invested in for the reason of, you know what? Let's go. Let's freaking go, guys. Let's send it. All right. I think I remember. Well, you know what? Let's try. Let us try. Oh, yeah. Let's adhere to the cookies. Yeah. Let's do it. Investoren. Yeah. So one of you out there, a couple of you out there who are German might be proud of this. Let's go. Okay. I wonder where's the SEC filings. All right. They made it too easy. Aha. All right. Let's go to the annual filings. Aha. Let's go to the PDF. Oh, how to do that. I know, I had to do it. All right, so let's see here. Select consolidated financial data. Click. Scroll. We're just scrolling down. We're trying to find that balance sheet in IFRS. IFRS. Oh, no. All right, I guess I kind of goofed up there. It was not in that hyperlink. I don't care about any of this. I'm about to give up and just search cash. I'm giving up. I'm going cash. Oh my gosh. All right, cash. Let's see if they do and. Nope. Cash. Please, please. Okay. 34 mentions. Jeez. Oh, there it is. All right, cool. All right, we found it. There we go. All right, so this is why so many people have a hard-on for this company. All right, so let me see how you guys see it. Yeah, you guys are, there you go. All right, so intangible assets, I don't care about you. I don't care about you. Non-current assets. No, we have the current assets. By the way, IFRS goes in the reverse. It's not like GAAP, so here you go. Let's see here. Inventories, receivables, trade and other receivables. There you go. There's the number. Look at that. Look at that number. What do you guys see there? That's a $12 billion number. What's the size of the company? Oh, that's right, 35 billion. So 12 billion in receivables, that's what people kind of point to, and they're like, okay. So I just wanted to cover that and just let you guys know. And so there you go. So this is in euros. So it's 12.3 billion euros in receivables. That's money owed to them within 1 year, or as Jeremy would say, give me my money. Give me the money that's owed. What is Tattooed Chef at? I have been out of it, so I haven't even been, oh, don't want to do that. TTCF. What are you at, Tattooed? Oh, it's at $6. Do you guys think I should actually buy this? Oh, yeah, no, yeah. it's a 20F, yeah. I mean, I'm kind of okay reading IFRS too. It's a pretty easy transition to go. Schön, Fabio. All right, so what do you think about SWK? So SWK, last time I made a video on them, we talked about how inventory was stacking up for Stanley Black & Decker. And so it was, I know like the original video back in like end of 2021, early 2022 was like fairly neutral, positive. It was not like a buy back then. And thank God, because look, it was not a buy. But they're basically down to pandemic levels now, or very close to it. And so they have a lot of brands. They have a lot of basically write-offs that they do over time though. So just keep that in mind. So Stanley Black & Decker, let me show you. You know, I don't want to be like, you know, rosy, all too rosy with it. But, you know, check this out, guys. So you go here. Let's go to the investor print. No, I don't care about. Why not? Let's go look at their presentation. Why not? 49 slides. Forget it. All right. Let's just have it here, though. Let's just scroll through this. See what they kind of. Look at that. Look at that. We're #1 in tools and outdoor. So all this is true. Like, these are all good reasons to buy the company, right? These are all good reasons. So, but there is one thing. And they bought some of the brands from, I think, like Sears and stuff. But let's go here. Where is it? Where's my SEC filings? Financials, SEC filings. All forms, annual. Let's go to annual 10K. Yeah, why not? Why not? Let's just go to the annual. All right. Back to GAAP. Financial statements, supplemental data. Okay, there we go. All right, so just one thing I want to highlight as something you want to pay attention to. You know, just take a look at that. Take a look at this goodwill and their history of writing stuff down. But yeah, not like the worst. Not like other companies that come to mind, like Newell Brands. But yeah, they've done it a decent number of times, so it shows that sometimes they're a bit aggressive on the empire building. Not the best for shareholders all the time. So, you know, just keep that in mind. Dan Weston has an opinion saying trash tool brands. All right, so there's something to think about. They are definitely not #1 in his heart. We're #1. Rue. Oh, who's #1? $500 on TTCF. Oh, so I should actually buy some TTCF. Heck yeah. Shelf space cut in half at my target. Not good. Yeah. There's some people who have been talking about. Oh, Illinois Toolworks, ITW. Yeah, we'll talk about ITW. ITW has that king. I think they're a dividend king. Illinois Toolworks sitting at. Yeah, they're not they're not cheap like Stanley Black & Decker, but look at that chart. 20,000% returns, not including that dividend. Bring Dan Weston back on. I mean, I can have let's do a live stream where okay, mark it down. Saturday we'll do a live stream where subscribers can come on, because Friday is when I have this exam. And so on Saturday, I can definitely have the subscriber come on live stream Saturday. So yeah, we can definitely do that. And anyone can really come on. I'll have probably someone trying to see or vetting people who to come on and stuff. So I can kind of segue that over to someone else. But okay, we can do. Let's talk about Blackstone or BlackRock. Sorry. Oh, no, sorry, Blackstone, not BlackRock, Blackstone. All right, so the thing with Blackstone. So they have two different strategies, Blackstone, BlackRock. But basically, think of them both as asset management firms that split off at one point over disagreement in strategy. And their names are very similar on purpose. They're basically saying the same thing. Blackstone, BlackRock. Go figure. So Blackstone is basically like a REIT, and they're very good at raising capital. They've raised a decent amount of capital this year alone, even in a crunching liquidity environment, which is very interesting, very nice. They've made a ton of agreements over the past couple years regarding real estate acquisitions. Again, you can almost think of them as a C Corp REIT. They used to be a partnership, by the way. If you guys have been in the markets for enough time, you guys probably remember when Blackstone was a partnership. And then they made this transition over to a C corporation, I think in 2019, sometime around there. And they've performed really well since then. Goes to show, and there's some reasons for that. And I don't know if I'll get into those reasons, but I think I went over those reasons in the call for a different company. But there's a reason why switching over from a partnership to a C Corp would be beneficial. But yeah, Scott lives 15, 20 minutes away from me. What the heck? Who are you talking about? Oh, you guys are talking. Well, yeah, we won't dox anyone. Scott doesn't watch my videos, but yeah. Gilbert, okay. So, bro, I'm looking at ITW. Who is looking at ITW? I find them interesting. I think the subscribers here were looking at ITW. I feel like most industrial manufacturing plays have some ways to fall. Thoughts? I think so too. But this is the time where we might want to look around and find one that we do like, and then start acquiring them. Same with semis, right? So semis are going to go through a downturn. You can probably keep an eye on that. So, almost forgot. We can talk about Micron. So this was another focal point of talking about Micron. So Micron Technologies is a very, very, very popular semiconductor stock, and this one is one we discussed also on the call. So in this one, what I want to focus on in terms of the TLDR is that Micron, I'd probably only be buying it at or below book value. I know that's going to be sacrilege to some of you, but if you actually look back in the past, you probably would have done pretty well buying Micron. Not all semis, but Micron in particular at or below book value. And tangible book value. But really, the tangible book value and book value shouldn't be too different or far off because they don't really have a lot of intangible assets. So, yeah, that's Micron Technologies, guys. And other stuff like I think NVIDIA is going to have, I agree with some of the subscribers' research that it's going to have some more ways to fall. A lot of, we're probably going to be in for more of a surprise than what people think as far as the counter cycle for semiconductors. Now, there are going to be some very interesting pickups. And so like what we were just saying with industrials, connecting the two themes together, if you want some industrial exposure and, semi exposure, now might be time to set up your shopping list, right? Set up your shopping cart. What are you going to be buying? And then, the thing is, if you're not buying when they're coming down and no one wants to buy them, then, you're going to kick yourself when you didn't buy them. Because one thing is for sure, semis in the future, it's an industry that's here to stay. Some of them are incredibly more overvalued than others. ASML is actually one that's pretty overvalued. But that one, don't be surprised with that one. And by the way, Andrew, we did talk about, I know that you're in here now, we did talk about Qualcomm already. But yeah, Qualcomm was really interesting. I bet Fabio's employer would love that. Would love what? What's going on? Stocks anymore being... Oh, I can talk about those kinds of stocks, Fish Fan Man. But yeah, wait, I don't know who the didn't I see you comment on Scott's video that you want to expose Kitham? Oh, that's not towards me. I was like, I didn't comment anything. I don't comment on anyone's. Okay. Okay. I personally think I might do a long Qualcomm shortened video trade. I know we've been talking about that. And I've seen that commentary, of course, in the Discord. But yeah, Fabio loves talking about Qualcomm. No, we talked about Qualcomm for a little bit. But yeah. For me, Micron, I'll leave it at that. But wait, there was someone else's question I wanted to get to. Oh yeah. So pot stocks. The only one that I'd probably be buying in terms of MJ, and this is something that I don't know if you guys knew this about MJ stocks. As far as their tax accounting goes, they're not allowed to deduct the operational expenses. They're only allowed to deduct the cost associated with the product itself, but they can't deduct I think they can't even deduct the actual cost of goods sold, or maybe one of the others. But the point is, they have a horrible tax treatment on top of that. And I mean, you could say that that's a point in time where that would be very bullish for these companies, that change in federal tax law, or that change in the law, because all that has to happen is that they have to be federally legalized, because the tax code basically makes it so that you still have to pay tax on illegal services conducted. And I'm pretty sure it's the operations that you're not allowed to deduct. If I remember correctly, it's the operations you cannot deduct from the product itself. But the cost of goods sold, the cost of production, I think you might be able to deduct that. If you don't, then it's like double bad. So yeah, they're not treated well. Okay, so worried about CE's acquisition being rough on their balance sheet? No, I'm not too worried. That is a concern I addressed in the CE video, that in a downturn, it seems like they're taking on this leverage in the midst of a downturn. So that's a bit of a concern, yes. But I think that's why I'm building out the position. It's not a position that's built out at all by any means right now. But over time, I want to build out CE into an actual position. So that's what I'm saying. I'm sticking through. Like I agree with whoever was the one who commented about industrials. Maybe it was you, Ricky. But industrials have room to fall, and I just want to build out my shopping list and then start acquiring some of these companies at prices that I like. So that's kind of what I'm planning on doing over like the next year or so when I have time. So when I say I have time is when I have time to research these companies and stuff. But yeah, the one that I'd be interested in terms of marijuana is the one that is our MJ's, I think innovation properties, something like that. It's the REIT, because they, by extension, are basically acting like a bank, a quasi-bank, through the sale leaseback method of real estate. And they're basically providing a lot of financing for these marijuana companies, but at the same time also getting that exposure to their growth, getting the rent instead. They're legal entities, so they get those benefits. They're a REIT, they get that tax-through benefit, etc. But yeah, so to close off the question for Fuhat, I like Blackstone, by the way. So I realize I didn't answer your question, but I do like Blackstone. The one thing I wish they would do more of is not so much focus on capital return in the form of dividends. As a C Corp, they don't have to anymore. And so I would prefer them to actually focus more on maybe getting that capital and investing it into other projects. But maybe then again, they don't have any other projects to invest in, and they have plenty of capital coming in from outside investors. So they don't really need to take a higher stake in it themselves, because they're very similar to, I would say, Brookfield Asset Management, or BAM. So with BAM, you get that exposure where BAM owns portions of the entities that make the investments, as well as they have outside investors that own or shares or also are invested in some of the assets that they take partial ownership in. So yeah, with BAM, you're getting a little bit more direct ownership of those said assets, as well as those management fees that they generate. Let's see here. It's very Scott. Oh, she sells to dogs. Oh, they're cheap as heck with operating well, but I don't invest in MJ. Yeah, I mean, I'm not really too much of a MJ investor myself. I wouldn't say. Which MJ stock has the best product? Show. I have no idea. Maybe someone else here knows, but yeah, I don't know. Yeah, that's what I'm saying. IIPR, that's the one. But they have a great dividend because they're a REIT, by the way. So that's why. I think they're trading cheaply now, relatively cheaply compared to before when everyone was super excited about them. So they kind of came back down to earth. This would be the only one that I'd probably get that exposure to the MJ space, but it's not an MJ stock. So there's also another kind of company that I am looking to acquire, and it's actually within. Can you get started on it, and I'll close off here, and then I'll come down and we'll have the salmon. My wife's like, we gotta eat the salmon, and I'm like, yes, I'm looking forward to that salmon. All right, but yeah, that's pretty much my opinion overall. Let's see, anyone familiar or have read Financial Intelligence by Karen Berman? No, I haven't read that. I like oil. I like hemp. I like. Tuition question will follow shortly. Sure thing. We can answer that. I like dogs too. Personally, I think the chemical sector has some low-key gems. Yes, of course. Thoughts on LYB? I own LYB. I like LYB. I think they're one of the best management combo of ROIC, ROCE. Thoughts, capital? No, I mean, I own them. I can't speak. Did you not know that, Ricky? They're one of the ones that I own. They've been in the portfolio for quite some time. I think I'm down on them, and I can actually average down my position now. So, yeah. I can. I'm interested in them. Yeah, no. I've owned them for a while. I think I acquired them last year. End of last year. So I collected the dividends from them, the special dividend as well. They gave me a special dividend as well. That free money. I'm just pissing off the anti-dividend people. Yo, Chef Wolfgang. Yeah. I actually know someone who has a chef, but must be nice. Must be nice. I don't know what the income threshold I would need to have for me to justify having an actual chef. But must be nice. I have a friend who's basically a chef, and he cooks some exquisite food. I'll tell you that. And we always go to his house, and yeah, it's a good time. It's a good time. I actually went there last time. You guys remember I was on Strongman's live stream, and I had to leave the live stream to go to a dinner. We like to do that dinner minimum once a month, and then we'll gather at the house. Hi, I'm a chef. I'm terrible. Oh, you're not good at cooking? I'm like an enthusiast, but like I'm not a chef. And but my buddy, oh my god, like he's not a chef. He's an enthusiast too. But oof, like the exotic food, he makes that. My baseball teammates died. What is going on? Wait, Julius, what is the context of that comment? Well, you don't have the accent on there, so no, because Keithman Rahman, without the accent, you have you're saying something else. You're saying something else. but pão de queso, yes, we'll make that here and there in the air fryer, and it's really good. It's really good. But I think you meant that, but like, yeah. If you say that with the pronunciation without the accent, that's something else. Okay, so PhD just asked a question, and let me go back up here. So tuition. Question will follow shortly. Okay, so the question is this. Okay, so I have the question. I think I'm getting better at analyzing the quantitative aspects of a business, but how do you learn to analyze the qualitative aspects, such as discerning between a great, good, and fair business? Well, this is where like the art and the science come together, because I'd say like the quantitative aspects are like the science, and then while the qualitative aspects are like the art. And it just comes with time and experience that you simply just look at different businesses. You try to learn the most you can from other investors that have done it already for multiple periods of time. Every sector is going to be different than another sector. So if you like, one of the best ways is to get work exposure in different sectors themselves, and then you can discern whether or not something is good or bad. So like, for example, an engineer in a particular specialization is going to have a fairly good idea of which companies are providing the quality product versus non-quality product. If you're working in the field, you might get understanding of the work environment, because I like to say, remember, believe it or not, in a capitalist society like we are, kind of, you want the company to make the employee, the talent, the labor, you want them to be happy working at your place of business, because if not, and your competitor is a better place to work, they're going to suck up all the talent. And with the talent, of course, comes the quality. So you want that balance. So you want to make sure that the company you're investing in is a good place to work, has that good culture. That's going to be that's a bit more difficult to discern. You can try to use websites that have employees complaining about the company. Be careful to say, because usually maybe the only people who are complaining, people were fired. But try your best to find that out. Try to see what consumers are saying about the products. It depends on what the product really is, whether or not you're going to find available information. For example, cybersecurity companies, there is a lot of free resources out there where you can see people kind of rate the different products, such as like CrowdStrike versus Checkpoint, and you'll see, for example, that Checkpoint's not that good, Fortinet's pretty good, CrowdStrike's pretty good, and really good for what they do. So you get that qualitative aspect. Of course, you can try to see what the wisdom of the crowd is saying about a particular product. So typically what I've seen is, the wisdom of the crowd is right. A lot of times, like, they'll say the quality of this product is really good versus another product is really bad. And like, for example, we can say that if you look at what everyone says about Alteryx, right? Alteryx is really good product, low code product, fairly easy to use, and so it can be easily adopted by enterprises. But then you want to do the quantitative analysis and say, okay, well, is it now a good price, now a good investment, beyond just like the qualitative aspects. And then another example you could probably get into is someone who's worked or believe it or not, like in retail, for example, kind of trying to understand the business is very important. So, for example, with this whole spiel of how many SKUs does Tattooed Chef have? Well, if you kind of got familiar a little bit with retail, you'd understand, well, that's not necessarily what you can't tell all the time from just looking at how many SKUs are available in there. Because you also get to know that companies pay for the brand where they're located. So maybe they're paying a lot of money for them to get more shelf space, for example. Because a lot of companies, they will stack their own products at the store too, and then they pay for certain shelf space, as an example, and that's an upsell that the store will do for that client. One thing that, like, you could start reading like case studies of businesses too, to try to get familiar with all the different strategies that businesses employ to make money in their different sectors. Like, for example, a very popular one I'd say is like, okay, what's the difference? This is fairly easy to understand, but this is like a good start if you're asking where to start. Understand the difference between something like a Walmart and Costco. That's usually a very popular one that beginners go to, because it's very, very easy to kind of get in there and understand the nuances and the differences between Walmart and Costco, and how each one makes money. And, well, by the way, Walmart owns Sam's Club, but just thinking of Walmart, or Target. You should go easy, Target. And then also it requires a lot thinking outside the box. Oh, this is another thing we talked about. So there's a reason why I like Target, or looking at Target's earnings reports for the U.S. consumer versus Walmart. I much rather look at Target over Walmart to kind of gauge the health of the middle class in the United States. For one, Walmart's a global enterprise. So it has businesses, it has stores in Canada, stores all over the world, basically. And another thing is Walmart's already the low-cost provider, or one of the low-cost providers. So they're considered like a discount store. So if the consumer's not doing so hot, they're going to kind of flood over to Walmart. Of course, you can look at that discretionary spend, which we've talked about in the Walmart Target videos. That you want to look at that discretionary spend, how that's doing, and it has been coming down. Actually, in the most recent earnings report, you had Target and Walmart both talk about how the discretionary spend is suffering. And of course, you have Best Buy that basically is all discretionary spend. Best Buy is making some adaptations. Don't want to go into that tangent yet. But sticking to Walmart and Target, Target is considered the more expensive store. So you get a double whammy that they're US centric. They're only in the United States. They don't have a Canada store. They might have like maybe one, but for the most part, they're US centric. So you get that feel of the United States. And on top of that, they're considered the higher end store. They're like a higher end Walmart, right? So if people are making that decision, if the consumer's making that decision to maybe shop less at Target, more at Walmart, well, that's going to tell you something. And on top of that, the discretionary spend at Target, you're going to get that feel of that consumer a lot more. That the company's going to feel that definitely more than Walmart. Walmart has a greater proportion in necessities than Target does. While they both have the necessity spend and the discretionary spend, Walmart has far more exposure in necessities than Target. So necessities, what I mean is food, stuff like that. So, and discretionary spend, think like TVs, toys for kids, anything else that's like not necessity. If you can live without it, not necessity. But yeah, Target's a good example of that, and I think like they're kind of a way of thinking outside the box of like why they're superior to look at than Walmart for the U.S. consumer. But yeah, like that. Those are some ways that over time you'll just develop. But I think obviously the best way is to have exposure to that field or know someone in that field, and you can ask questions and ask them like, okay, well, what makes a company good? What are some qualitative aspects that make this company better than another? Why is their product better than theirs, et cetera, et cetera. And you can build off of that. I do need a clone to read chats. Yeah. What's going on? Capital Mindset. I'm changing a major from applied math, potentially to finance, actuarial math. You think this is a good degree to get a CFA or work in the field similar to yours? Applied mathematics, and then you're switching over to financial actuarial math. Well, no, I mean, like you'd be fine. Like if you in applied math. So a little bit of context. So I had a tutoring business where I tutored a decent amount of kids over time, college kids, high school kids in dual enrollment and stuff like that. And so I went above the math that I ever needed for what it is I'm doing. So like, for example, in accounting and finance, you don't really need, like, guys, statistics is pretty freaking easy. So like, you're not going to be, I took up to, I think, Calc 2, and I'm never going to need, any of the stuff that I really did there. Of course, it's nice. It makes a lot of the other math, pretty like nothing compared to that back then in those days. But no, I mean, you can keep that same major. A CFA, as far as the requirements go, you just need to pass those exams, study for those exams, and then pass, and you're good to go. The major itself doesn't matter as much as like the work experience. So if you're thinking about doing that and you want to work in that field, you know what? Just go ahead and attend your university's events where the firms come and talk to the students. Take advantage that you're a student. Now that I'm saying this, because I had this chat with one of you on the Discord who's younger as well. If you haven't downloaded Handshake, what are you doing? I'm talking for the people in school. If you're out of school and you're a working professional, don't download Handshake. But if you're a non-working professional and you're a student, download Handshake right now. Like, do it right now as we're talking. So go on your phone, go to the App Store, download Handshake, set up your profile just as you would, LinkedIn. And download Handshake and set up like what it is you're studying, et cetera, your experience, et cetera, your internships, and then start getting internships in that area, get that work experience. And that's going to do leagues better for you in terms of like, breaking in. And depends on what you want to do. So like, are you looking to go the traditional route into IB, investment banking? And if so, I mean, you could go for it with what you got. And then if you get your CFA or you pass your exams in your CFA before you graduate, like a Chad, you'd be a very attractive candidate because that's a flex, first of all. So, but yeah, that's Kath Mim's question that I'm answering. Because all of you guys seem to arrowed up his question. I think it was this one. Yeah. So that was this question. But yeah, like a CPA, you do need educational requirements. So a CPA, you need the 150 credit hours, 30 hours in business, and then that qualifies you for the CPA. Most people get their master's to get the CPA. But yeah, and then I'd say like CFA isn't really like a requirement for a lot. This really does depend on, like, I guess the business that you're going into. Like the company, maybe it requires it, maybe they don't require it. Doesn't matter. Let's see here. Trying to see. Oh, Skyworks Solutions. CMI is Cummings, right? Yep. Skyworks Solutions and Cummings. See, I'm basically getting to the point of a yellow book of stocks. So Cummings and Skyworks Solutions. Skyworks Solutions makes RF. RF engineers are becoming harder and harder to come by. But yeah, Cummings is another one that I was looking at, and it kind of slipped away from me. I talked about it in old live streams, and I talked about it positively as one of these boring, very boring stocks. But yeah. Fubo is the future. Yes, we talked about that earlier. But yeah, Fubo is the future. I think I have to go buy some Fubo. Hey, no worries, man. No worries. Of course, you can ask follow-up questions if there was a part that I didn't really answer as much in depth as you want. Sometimes my brain goes all over the place, especially after studying regulations. Regulations all day, every day. Oh, I need a clone to read chats. Yes, I do. Dan Winston, who the Might Brand, Fu Hat Ranch. Just reading through these comments. Cosplay girls. How did the conversation get to cosplay girls? Yeah. And also the genetics is important, because also like the age factor. So it's a good age factor, good genetics. But yeah. Yeah, I got married. I got married pretty young, but it was a good decision because, first of all, when you're, well, I guess for everyone it's different because like when you meet the right one, you met the right one, and that's different for every individual. So this is not that kind of video, guys. Don't worry. Maybe I should make like a red pill video. I don't know. I'm kind of confused on the whole red pill thing. Is it like only married men can truly be red pilled? I always forget, or is it I don't know. I don't know what the pills are. Too many pills. No love for Levi's. Then I can force her when she's out of her. Oh my God. No, Ricky. No, bad Ricky. Yes, no, Dan Weston. It's all IRS code, all regulations on tax law, contract law. Contract law was like pretty fine. Contract law was like a review of stuff, but yeah. Next call, Andrew. You can run me by the red pill. I think that would be an interesting conversation on next Sunday. Daniel Souls, do we red pill Fabio right now? Oh my gosh, no. Oh gosh, let's start a new pill, the unplugged pill. Oh my gosh, no. Is that like suicide? A reference to suicide? Made the Off the Pill podcast. Oh my gosh. Off the Pill podcast. Like, okay, you're getting off the red pill, you're coming back. I mean, if it's like I don't know. I'll say one thing. I've seen some very cringe behavior from all genders. All genders. I've seen very cringe behavior. When I see that cringe behavior, all I have to say to me is I am glad I am married. But yeah, I have a problem with the Cole for promoting promoting to go live the matrix. Oh, live in the matrix and aim for a simple, basic investing lifestyle approach. King of the Hill pill. Oh, King of the Hill pill. All right. So someone said Levi's. I don't really like these stocks, guys. Levi's. I mean, look. Just because I don't like it does not mean it's bad. Does not mean it's bad at all. I just don't like. It doesn't get me excited to own it. I don't know. Maybe that's a good thing. Maybe that's why it's going to be a good value because a lot of people feel the same way I do, and then maybe it's a good value. That a lot of that makes. Fuhat, you are really pushing the food. All right, well, you're right, Fuhat. You are right. Okay, people do need jeans, Hazard. People do need jeans. You're absolutely right. We were actually having this conversation with. It was what was that? We have. Come on. Revolve. Yes, because we were looking at clothes and Revolve in the call, and yeah, it was. I think the whole conversation was it's an expensive store for most people, but yeah, All right. I'll close off with some final questions, and then I'll close it off. So let's see. Thinking about buying DraftKings, thinking of NFL, NBA season will be good for online betting. I think it will. I don't like any of those companies. I don't like any of those companies. But it could happen. Could happen. Save the marriage with salmon. All right. I'm going to go eat my wife's delicious salmon. All right. Oh, gosh, that sounded terrible. But, yeah. Actual salmon, the fish. Okay. Can you check out Textile? They are the owner. I will have to check them next time because I am going to eat salmon. I'm going to eat food right now. All right, guys. Thank you guys so much for joining the show today. And I know it's been a very long time since we did a live stream. So check out the live stream on Saturday. And if you're one of those who wants to come on and have a conversation, you're more than welcome. The only thing you have to do is pay me about $20,000 per second. All right, per second. And I'll tell you this. It's only going to go up in price. So if you pay me now, the $20,000 per the seconds you wish to talk on Saturday, it's going to be $20,000. Every day it goes up 100%. So, get your exclusive slot in now because it's only going to go up from here, folks. With the coupon code, I didn't plan this out. So coupon code Finger Lakes. I have written down here Finger Lakes of New York because I think Dan Weston told me to go visit Finger Lakes of New York. So Finger Lakes with coupon code Finger Lakes. There you go. That is the new coupon code. All right, guys. I'll see you guys on the next one. Bye.